Hey guys, this is Brad from Blue Nile Farm. Are you thinking about putting up a new building or maybe getting some new big pieces of equipment and you're kind of like trying to figure out how do you go about it? Talk about financing because nobody likes to discuss this topic. And it's something that I think is pretty important for somebody that's involved in the agricultural world. And depending on your level of experience in farming, we all think, hey, I'm a farmer. I want to go down and talk to my lender, give me some money, boom, so I can go out and make some more money. And unfortunately, it doesn't work like that. So what I'm here today to do today is discuss how to go about getting lending for a farm lender. What kind of lending is out there? And I'm not a banker by any means. I'm just like you, somebody that's trying to figure out how to go about getting a loan, how to get started. And I've been farming for over 30 years. And when I first started and the hurdles I've had over the years to where I'm at now, things have changed a little bit. And I want to kind of talk about these things. So maybe they'll help you out if you're trying to get a foundation of what do I do? How do I go about getting a lending? How do I expand my operation? Or how do I start farming? All these questions all come up to everybody. And it sucks when you start, and it sucks when you get older. And basically, getting and borrowing money just purely sucks. But we're going to talk about it, and hopefully, it'll be helpful to you and give you a little bit of foundation of things I'm dealing with, and maybe you can relate to this. So stay tuned, and we're going to talk about ag lending, how to go about getting the loan that you need so you can get started on your farming operation. So I want to give you a little bit of background so you understand where I'm going with this video. And to give you a little bit of background about me, because there may be something that you could relate to, and depending on where you are in your life, you can kind of figure, where you fit in this realm. So 30 years ago, I had a off the farm job and I bought my property. I developed my property, built my house, built my barns, and it took me a good 10 years to get started. 2005, I decided to open a horse boarding facility. We had a 21 stall barn, and I also had an indoor riding arena, and we started boarding horses. Throughout the years of boarding horses, we've had some ups and downs with that. I've been through two divorces along the way, uh, which basically were setbacks financially. And I eventually, throughout the time of boarding horses, got myself involved in hay production, and to where I'm farming about 150 acres of hay, and I needed a place to put the hay, and I wound up using my indoor riding arena to become a hay storage location. During that time, I also got heavily involved in rebaling hay, and the hay business became more prolific than the horse boarding business. So I took over the barn and made it more into my hay operation than the boarding business. So the boarding business kind of was taking a falter where the hay business was growing. And the downfall in between of all this is that I needed to have another barn for the hay, but I never got around to it. I also got involved in my farming operation to other income streams where I was doing side work of land clearing and putting in driveways for people to some of the equipment I had. I also got involved with selling topsoil, mulch, compost and manure, things of that nature that were basically creating other income streams. And that was working out for me pretty well. This year in 2024, right after Thanksgiving, we had a huge snowstorm and dropped that big indoor riding arena. And that became to be a huge loss. I had damage of equipment, and I have a building that's currently sitting outside with all my hay being exposed. And I'm taking a huge loss on the hay. I'm taking a loss on the building. I have damaged equipment, but luckily I was insured, and I'm going to get some money from the insurance company, but I still have a huge setback of cleanup and a rebuild that has to take place. Also, 19, 20 years later, buildings are very, very expensive, and now I have to build a building that's twice as much as what my original building was, at least just for materials. And I'm also in the need of making two buildings because I have two different businesses. I have a horse boarding business that needs to be brought back to life, as well as a hay business that is prolific and makes me money. So if I can get both businesses running together, I'm hoping that that's what I need to do because I plan on retiring from my job in the next several years, and I plan on using the farming business to keep myself occupied and keep income streams moving forward. So I'm in a position where I have to make changes. So that's basically the foundation of where we're talking about today. Is now I'm at the point where I have to build these buildings. I have to get a pretty sizable loan. I have to deal with my ag lender and see what I need to do to go forward. So that's what I'm here today to discuss to you. Where do I sit in comparison to you? And hopefully this video is going to be helpful to give you some format on how to go about getting an ag loan and where do you fit in this process. Because one of the good things that I have to talk about today is that I am pre-established in my farming operation. If I would go back in time when I first started farming, and I guess you want to say as a dreamer, and I didn't have no history of making money, I would have a little bit more trouble than I have now. And I'm going to kind of talk about all that throughout this video. So I'm hopefully you can figure out where you're at and understand some of the hurdles you may be facing trying to get a loan. And that's something that's very important in today's society. Also in today's society, we have higher interest rates. You know, it is 2025 right now, and interest rates are between 7 to 9%, you know, depending on the type of loan you have. And a lot of these loans are variable in nature. So depending on what happens in our world, you know, is going to dictate on these loans. And payback on these loans is pretty brutal. You know, when I started my farm back in 1995, when I bought my property, I was financing my house at 8%. So I understand how expensive it is to deal with high interest. And we're going to talk about that also. So so hopefully this will give you a little bit of foundation right now of where I'm at. So since I'm in the position of creating 2 new barns to enhance my property value, and so I can maintain my ag business so I can move forward and make profit, I'm in a position of kind of like a do or don't situation. Either I go all in or I don't even bother. And in my heart, I have to go all forward because that's the business that I'm in. I've spent all my entire life trying to build these businesses up, and just because my barn fell, it's time to fix it and move forward, and that's what we're going to wind up doing. So that's step one. Number 2 is you have to deal with the cost of construction. You know, cost of construction today is very, very expensive, and you have to do a lot of work to this. So you have to, make sure you got the foundation prepared. You know, you're going to have to find a contractor that's going to put these buildings up. You're going to have to deal with concrete if that's the issue. You have building material. You have the building itself if you're buying a kit or a part of the building from a manufacturer. And then you're going to have to find out your siding and basically any wood products. You know, then you have to deal with electrical, water, whatever that you need to impose in this building. And a lot of times you also have to cost in your doors. So there's a lot of different expenses that go into these buildings, and we just basically scratch the surface. So what I'm looking at right now is a building that is basically a steel building with steel posts going up and a steel truss. And that's what I'm looking at purchasing. Then it's going to be held together by wood to support it. So I'm going to have wood purlins with wood girts. And then it's going to have outside, which is going to be steel sheets. And that's pretty much how I'm going to build both buildings. Each building is going to be about 64 foot wide, 16 foot tall, 140 foot long. And that'll give me enough space that basically I have a indoor riding arena set up, as well as my hay operation. And you know, those are perfect sized buildings from what I want to do, and that's why I'm going to invest in this route. But you know, that's almost 18,000 feet of space, and you know, that's a lot of barn. So you know, for me, you know, it's at almost 60 years old, this is a do or die situation, because either, you know, a lot of people want to retire, and this is what I do my entire life. And, you know, since I've already started, I want to finish it off by, you know, getting these buildings up. Because worst case scenario, if I decide to sell, you know, I know that the property value and the money that I'm putting into is going to definitely improve my property values. And how do you sell a horse facility if you don't have the indoor arena here in northeastern Ohio? It just doesn't work. So everything I'm doing is a pure investment to my property, and I think it's money well spent in the long run. And I'm putting up a commercial type building that's going to definitely outlast what I had before, because the last building I had was one of those coverall hoop buildings, and they're nice, but after you lose a building, you find out it's not so nice. And so I want to have a good solid building that's going to last and it's going to do what it needs to do. So that's the issue. Now, in part of this is that we're looking at dealing with the right type of lender. And the lender that I'm looking at is Farm Credit, Mid-America. And the reason for that is I have a history with them. And I did not initially have that history. But, when I first started, I had to go through I basically went to a traditional bank. And they gave me a construction loan and built my house and on some land. And that's basically what they did. But as time went on, I wound up getting a small business loan to where we built the horse barn and I built the indoor arena under that loan to start a business. And at that time, I was not pre-established, but we eventually started to get established, and I started boarding horses, and I started to have an income stream. And I did that for a bunch of years. Wound up getting divorced, and through that divorce, things kind of transpired, and I wound up having a few issues with the barn, and the barn pretty much took a backseat as far as horse boarding goes, and then I wound up getting into the hay business, and that really took off. And like I said, that's my transitional period. But during that period of time, after that divorce, is what finally got me to talk to an ag lender. And I started getting a financing for my property through Farm Credit Mid-America. And what was nice about dealing with an ag lender was the fact of that they understand farming, they understand the agricultural business, and they're more pro to work with you. So throughout the years, as I started getting in the hay business, I started to buy a lot of tractors and other equipment, and I started to create a history. And through that history, I developed a good rapport with my bank. Now, I didn't always loan through Farm Credit of Mid-America. There was other ag businesses and ag lenders in my area, but I wound up coming and dealing with one ag lender that knew I was, and they said I should be dealing with Farm Credit of Mid-America, not them. And I guess there was some kind of partnership, and they kind of pushed me to go dealing with Farm Credit Mid-America. And I'm like, well, I really don't want to deal with Farm Credit Mid-America. I want to deal with you guys because it seemed like they were more approachable. But I wound up getting stuck dealing with Farm Credit Mid-America, and I dealt with some of the lenders face to face. And I brought them out to my farm. I showed them what I was doing. And basically, they would give me some smaller loans, $10,000 here, $20,000 here, $50,000 here for equipment, and I would pay those loans up very quickly. Now, some of the things to my benefit is, number one, I always had an off-the-farm job, and that is a constant income stream, and they look for that when you start. If I was just a farmer and that was it, I think I'd have a harder time. So having a full-time job, making pretty decent money, that made life a lot easier to get established. But my problem when I started was I was never paying extra, say, on my mortgage or on my house. So over the last 5 to 6 years, I started making some serious payments on my house, and where now I have over 50% of it paid off. And I think that's a good positive thing because it shows that I have more equity in my property, and that's where I sit today. Also, my credit score is very high, well in the 8s. So, 800s. So getting credit is very simple for me because I have a good credit score. And I always have a history of paying things off quickly. And what I realized with the high interest rate, especially buying the equipment, and I'll give you a quick example. I want to buy an excavator for $50,000. That $50,000 that I had to spend on that excavator, I realized it was on a 5-year loan and it was only a 7.2% interest. But the issue was if I paid the interest for the 5 years and just made my basic payments, I would be paying them almost $11,000, almost $12,000 in interest. And it was like, whoa, 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 I don't want to pay that. So I wound up paying that whole thing off in a year, and all the money that I made on all those little side jobs and income streams that I do, I put toward that loan, and I paid that loan off right away. And I saved myself over $9,000 or $10,000. Now, for most of us, if we have $9,000 or $10,000, that's a lot of money to go out and buy another piece of equipment. So that's how I started to roll. I started to pay equipment off very quickly so I can avoid the interest rates. And that's just in my head. So even when I do my house payment, I pay things off quickly. And this is one thing you have to take in consideration when you're dealing with getting a farm loan or a loan in general, is that interest rate is so high, if you can't make extra payments, you're going to wallow and die. So I'll give you an example. Here I am sitting right now trying to get a loan through Farmers Credit of Mid-America. They're telling me my interest rate's around 7.5% to 9%. It's a variable. It all depends on where we fall. Bottom line is if I'm at 7.5% and say I take a loan for $200,000, okay, for a 30-year loan. The time I'm done, if I just made the minimum payment for a $200,000 loan, I'm going to pay over $500,000. So I'm going to pay 1.5 times just to make that to pay that thing off. That's crazy. You know, how are you going to justify that? So the only way you can really do well and pay off loans and getting in this kind of money is to pay things off early. And you make double, triple payments as fast as you can, and you change the amortization schedule by making these payments. That is the key, that thing you need to keep in the back of your head before we keep talking about this conversation. Because if you make minimum payments, you will never get ahead. You need to change the upfront loan immediately. And that's my best suggestion for you when you buy a farm. But the problem is most people that start off don't have, you max yourself out. And then all of a sudden you don't have money to go buy the equipment, or you don't have money to pay down your loans faster, and you get yourself in financial hurdles. And that is how we all started. I built my farm basically on a credit card with huge high interest rates. And it took me a long time to kind of get out of that. And so what I'm trying to tell you is be prepared that regardless if you want a farm or whether you even live in the suburbs or any kind of house that you want to buy, the quicker you pay these things off, the better off you'll be. You know, and I'm not afraid to get loans, but what I'm telling you is pay these things off fast, because the quicker you pay them off, the more money you save. You can't keep buying and getting loans all day long. The less is best theory is the best thing you can, and create yourself a wealth of assets. And we're going to talk about that here in a second when we talk about financing, because this is what lenders want. They want to know your history, how equipment you paid off, what are your assets. You know, they want to have a worksheet to find out, you know, what you own and what kind of assets you have versus your debts. So it's, you know, like almost like a debt to income ratio. You also want to find out what assets and what collateral that you have and what makes you a good risk. And that's why it's really tough when you're starting off the farm, is because you're walking in and you have no history. You have no financial history and you don't own anything. And it, you know, and people, and I've done it before, and I talked to my ag lender, because you know what's funny is I just went in to talk to my ag lender a week ago, and this is what kind of why I'm making this video. And I sitting there, and you know, they treat you so much different when you're established versus when you're not established. And you know, I consider yourself, when I first met an ag lender, I thought they would just give me money just because I want to be a farmer, and they didn't want to give me squat. And so I think it was kind of funny. Now I have a lot more to offer. I'm in a better position in my life. I have a history of a job and employment. I have a great credit history. I have a little bit of cash. You know, I'm in such a better position. But the bottom line is, it doesn't make a difference, because even if they give me a big loan, I'm now subject to paying this loan off as quick as possible. And I really don't like the debt. I've really enjoyed not having the debt that I used to have. And it looks like I'm jumping right back into the fire again. But I also know that I'll never get my business started if I don't take this dive. And so what we're going to cover here next is what you need to do and how to deal with your ag lender, and why you should deal with an ag lender, and things you need to be prepared for when you go see your ag lender. So let's assume that you plan on going to an ag lender. And I think that's probably when you're dealing with tractors and farm equipment and buildings and even getting a farm loan. I think you're always better off to go to an ag lender. I think that they're going to serve you the best. They're who you want to have a relationship with. Those are the people that you want to be able to pick up the phone. They know who you are, and you say, hey, I need such and such, or I need a loan, and they can get it right to you. And you develop a really good relationship with them. Even if your interest rates are maybe not be as good as you may think. The one thing about ag businesses like Farm Credit Services, and what really kind of draws me into them, is that for most lenders, they're not going to really give you much of a break. You're going to say it's 7.5%, it's 8%, it's 9%. But the one thing with certain loans, and when I'm talking about these loans, I'm talking mostly about equipment loans that I'm familiar with, and as far as like construction loans, barns, they have something called patronage. And what patronage is, basically they give you back like 1 to 1.5% of whatever your value of your loan is. And ultimately what it can do for you is take say it's a 1.5% patronage is what I was told on average from Farm Credit. If my loan is for 7.5%, basically annually I'm going to get about 1.5% back. So technically they're going to send me a check, and that check I'll probably reapply as a principal payment. That's what I would do personally. But you're basically only paying that at 6% interest versus 7.5. So you're actually going to get it at a lower rate as long as you stick with patronage, and that is something that's kind of an extra bonus. So we'll leave it at that. Secondly, let's assume that you've got a plan, you know what you want, you know what you need. You're going to make an appointment to go meet with somebody from a farm credit type of ag lender. So one thing I think is important for you is you need to be prepared. You need to have a business plan if that's what they're asking for. If you know, so they see you want to definitely take. If you're working off the farm, you want to take your W-2s for that year. If they don't have a relationship with you, a lot of times they want to see at least 3 years of income tax statements. I actually, bring the whole book with me, and I let them go copy what they want to copy. A lot of times they want to see your expense report, basically just the big numbers, and a lot of times that's going to be included in your W-2s, especially if you're an established farm. And that's what's really important, is being established. Going in when you are established is a lot easier than going in with more of a business plan that you're trying to set up a farm. The other thing that they're going to look at, besides W-2s, if you have an off-the-farm job, which is probably one of the best things that you can have, they're going to see if you have any deferred comps or 401ks or any kind of investments. They want to know the totals that are on that. They also would probably like to see a balance sheet. And what I call a balance sheet is basically they want to have an inventory and a dollar amount of every piece of equipment that you own. And whether you talk about tractors and combines and balers and hay wagons and implements, skid steers, excavators, the list goes on. And they have a dollar amount what that value is worth. And so what they do is they create that as forms of assets that you actually own. When I started, I owned nothing. I had nothing, and I kind of laugh. I look at it 30 years later, I have so much stuff and such a value of what I expended. And a lot of times, like a tractor might be worth $8,000, and 1 year I'm putting a new engine in it, shoots the price up to $20,000. So, you spend a lot of money, but of course that equipment is of value, and that's what you want to do, is have a balance sheet of what all the equipment actually is worth. That's why, for me, the better you take care of it and you don't leave it outside, it doesn't get roached out, at least keeping a good value of what you actually have. They also want to see what you actually have as far as your bank accounts, what you have in your savings, what you have in your checking. You want to know that. You want to know personal property, like on tools, what it's worth, what your house is worth, what your home goods are worth, what your farm is worth, when's the last time it was appraised, what's the appraisal of that farm. You want to know basically every little nook and cranny of what you have invested, what you've paid off. The more of your house that you've paid off, the better off you'll be. And this is, again, one of the suggestions I have. If I start a farm from scratch, and unfortunately, it's really tough because you have to buy all these extra expenses. And that's what kind of hurts you when you're starting a farm, unless you have a lot of money. But, most of us, we go through and we struggle. So it's very hard to get established when you're young. And that's where borrowing really takes its toll. And that's something I find. But these are things that the banks want to see, and you have to be prepared for what you're walking into. And like I say, if I wanted to do what I'm doing right now 30 years ago, they would have laughed me out of the bank, and it wasn't going to happen. But today, life is a little bit better. I'm in a different position, financially, economically, and I think, I've also proven a track record. But you got to start somewhere, and I suggest this is a good way to start. The key, though, regardless of what you decide to do, is to talk to your lender, make sure you guys and they understand everything. And when you go get a loan, like in my situation, I'm going to be building, I want to be overestimated. I want to know all the costs of the building. I want to know what the wood costs are. I want to know what the steel is going to cost me. I want to know what it's going to cost me for excavation, any kind of material, whether I'm putting concrete in or whether I'm putting gravel in. I need to know what the contractor is going to charge me. So I don't want to, I would rather underestimate than overestimate. So what they're going to do is they're going to give me a lump sum and say, okay, you have accessible $250,000. Then as you do your construction, you start buying your material or paying your labor, you're going to do what's called a draw, and you're going to draw on this loan. And eventually it's going to be treated like a construction loan until the loan is actually completed. And then they're probably going to roll it into one lump loan, and they're going to do a appraisal on my property. And a lot of times there's going to be fees associated with the appraisal. It might be as much as 2,500. It could be less, could be more, but it gives you, just give you a roundabout number, and that would be absorbed also into the loan. So any kind of fees that they have, they're going to put into this loan as well. These are things you need to talk to your banker to find out what you're getting into. And again, this is one of those issues. And sometimes, even if you agree to a certain percent and say that prime goes down because the economy is getting better, a lot of times the bank will work with you and actually drop your rates down because of just the way inflation is. And that's a good thing too, because they're working with you and having somewhat your best interest at heart. But I think they're also dropping it because they're afraid you're going to refinance somewhere else if they don't do this for you. So it's really a good thing to have. And again, better you can create a relationship with the bank, the better off you'll be. And anytime you think about borrowing a large amount of capital, it's scary because you got to make sure that you can make the loan. Now, do you want to be at a shorter rate or a longer rate? And the answer, I think, is you want to have the lowest payment possible if you come into times of hardship, but you want to be able to make the most of your payment that you can. So whether you have a 15 or 30 year is irrelevant, but as far as like the payment goes. But I think it's in your best interest to get a 30-year loan if you can, the longest loan possible, and make the highest amount of principal payment in addition to your payment. So say your loan's for minimum is $1,000. I would try to make a $2,000 payment, $1,000 on the loan and $1,000 on principal. The quicker you do this, you're going to change what you owe, and it's going to be more doable. You want to change it to where you're not paying so much in interest and you're paying more in principal, and then it's kind of like a scale. It starts to reduce quicker. That's the only way you're going to get out of debt. If you make just basic minimum payments for the first 10 years, you may just be paying principal and you can't get out of it. But every time you pay extra, you're changing the amortization schedule in your favor. And unfortunately, you are going to pay some interest, but you want to pay the least amount of interest possible, and you want to pay off as quick as possible. So one of the benefits in the way I look at making these payments to make yourself easy, and this is why I've been so successful with it, is I treat my farm as an ongoing expense. And every time I make money on my farm, I reinvest it. And I reinvest it to pay down your loans. I don't live off my farm income. My farm income is extra money. It allows me to purchase farm equipment and equipment that I actually have. My actual job also pays for the farm, and it also pays for everything else. So my suggestion to you is get yourself a good job that allows you to play farming. And as you grow and develop, it may take a lifetime. If you're one of these fortunate people where the farm has been handed down to you, or you buy it from your family members, and you're able to sustain it, that's great. But if you start from scratch, it's really a tough ride. Unless you come and have a lot of money, it's really tough. So, be prepared because, you want to be debt-free as quick as possible. And that's my suggestion, is work with your bank and come up with a way to pay it off. But regardless, in my personal opinion, banks are not necessarily your friend. They do make a lot of money out of you, and the only way you're going to recoup is pay it off quick. And unfortunately, in the way the world is, if you don't make these payments, you're not going to happen. I'm kind of surprised when suburban people, they go on and spend $400,000 to $500,000 for a home, and I don't care if the husband works and the wife works. That's a huge amount of money, and they're in the same boat as we are as in farming, that they're paying a lot of money for this huge house, and they have to make quick payments fast. And a lot of people are paying out of their league, and they can't make their payments. So don't be one of those people. Think before you act. Figure out ways you can make money. And that's the one thing that's nice about farming, is you can make money as an ag business. But if you're a hobby farmer and you're not looking at making money, it's going to be a huge problem for you for growth. But that's when you change and you turn it into an ag business, and then that money can go and allow you to have that kind of success. And that's what I really like about doing this. Now, there's another thing I want to talk about real quickly, and it has to do with your ag lender. Your ag lender is going to set you up on the best loan that's going to work in your situation. And that's something you need to talk to your ag lender about, because there may be different ways to tailor a loan and make it beneficial. Make sure you ask all the questions that you can. Make sure they're working with you, and that'll be the best solution I have for you. You got to ask them the ins and outs of what you're doing, and it'll make your life a lot easier. So there's a couple challenges you're going to have to deal with on your own personal level. One, One of the biggest challenges people going to get these loans is their credit score is low. Your credit score needs to be at least 7 or better, in my what I've been told. 7.5 is even in your favor. Higher your credit score, the more likely you're going to get a loan. The other problem is you'll look at your debt to income ratio, and that's another concern. That's why the less debt you own, the better off you'll be. 5 years ago, I was in huge debt, and I was in really big trouble, and I owed a lot of money, and I just crushed my bills for a 5 year period of time, and I really dropped myself down to where it actually works in my favor. But I had a very huge debt to income ratio, and it was hard for me to get loans initially, and I started paying down these debts, and life was better. But I had a lot of tractor payments, several tractor payments. We're talking thousands and thousands of dollars. And every time I had to make these payments, I tried to pay things off quickly. That's another thing too. If you're looking for tractor payments, you need to outweigh too. Is it better to buy a brand new tractor, or is it better to get a used tractor? Sometimes with the interest rate being so high, it's almost better if you can get a 0% interest on a brand new tractor based on the payments. Plus, you're going to have a tractor that's going to last you a lot longer, and you're probably less likely to have breakdowns. And one of the worst things I can tell you in the ag industry, and a lot of farmers will tell you this, especially even if they have to work on equipment yourself, when shit breaks down, it gets pricey. And if you got to pay a mechanic $100 some an hour, it's super pricey. And it's not uncommon for to pay 20 grand when you're done with the blown engine. It's not as cheap as people think. So it's very, very stressful when things go bad. That's why it may be worth your time to look into new equipment if that's where your game is. But as far as construction loans and barns, that's going to be more of a long-term loan, and you need to look at the long-term investment down the road. Because it is attached to your property, and it's going to increase your property value. A tractor is a little different. So you have to really research and do your homework on financing, because it really makes a difference. But ag lenders are probably one of your best friends to some degree, and it's the best resource I could tell you to go get a loan. Another consideration you have to look at also when you're building, say, a building, and even getting a loan in general, is looking for different tax benefits or tax write-offs. The one thing about farming is there's a lot of tax write-offs, and it's a way of knocking down a lot of your income and expenses. And there's a lot of write-offs available to farming, and that's something you need to take in consideration. Building generally is a longer-term way of getting a tax break, and that's a good thing. It's not a bad thing. Equipment, I think you only get like 5 years of new and 3 years unused. So, but it's something that you need to pay attention to as well, because that is something that's going to, come into play at some point for you to kind of get money back from the government. So, guys, with that said, in closing, I hope this was somewhat of a valuable video. Hopefully, give you a little bit of insight what you may be going into. It is a lot better when you're established versus when you first start. You're going to have a lot more hurdles when you're brand new, but it's up to you. Even if you're a long-term person that's been in the game, you got to have a job. That's in your favor. You definitely want to show that you have a good credit history, and the more capital you have available, the better off you'll be. We all have dreams, we all have goals, but we have to work extra hard to pay down our dreams and our goals. And I'm hoping that you guys are in this luckily in a good shape where you can go get loans and make your dreams come true. Hopefully this gave you a little bit of insight. Hopefully if you're new to farming, it kind of frustrates you maybe, because some of the hurdles you have, but I'm sure over time you're going to be able to flip these hurdles like they're nothing and be able to move ahead just like I am. It is a big burden to be in debt. Nobody likes debt, but unfortunately it's the only way we get ahead. You cannot make money without investing money. As far as I'm concerned, buildings are essential, and I can tell you from my own experience, when my barn fell down this year, it really shut down my business. I'm losing a lot of money. I'm losing a lot of time. It was a huge setback, and I don't even know what to tell you. So I can't imagine people that lose their house and buildings and everything that they own, from natural disasters. I just lost a barn, and I'm fortunate enough my house is good and everything else is good. But just that barn alone was a huge setback. So rebuilding is tough, and working with a good creditor is key. So hopefully you guys make good decisions, create a good relationship with your bank, pay your bills on time, and pay early. And I'm sure you're going to be way ahead in life. Thanks for watching, guys. Hopefully this was helpful. Talk to you guys soon.